All right, we're going to go ahead and get started. Welcome, everybody. My name is Andy Saldana. I am the Executive Director of New York Tech Alliance. I see Ben is just getting situated here, and let me make sure we have all the panelists. Wonderful. I just have a few quick announcements and thank yous before we get into the panel conversation. I'll be turning it over to Paul Ellis in just a second. But before we begin, again, thank you so much and welcome to the New York Tech Alliance's M&A exits during this time. Let's see. Pull up my slides. First off, we are recording this event, and we may use screen grabs from this event and share the video with people who were unable to attend. So just please be aware of that. A little bit about New York Tech Alliance. We are a nonprofit organization driving access, equity, and inclusion in the New York tech community to make it the most diverse and dynamic in the world. To learn more about us, please check us out at nytech.org. You can also email me to connect, andy@nytech.org. Of course, thank you so much to all of our annual partners that make the work that we do possible. Everybody from Xander Eisner Emperor, who's on the panel today, to Witham and Propeller, EY, Google, Grasshopper, Paul Ellis, who's hosting the panel today, and then Sabity, CEO, and of course Nation Builder, who supports our website. I'd also like to make an announcement that we are recruiting volunteers. We just launched our New York Tech Alliance Volunteer Corps. We are recruiting volunteers to help local nonprofits build tech solutions or support their tech needs. So if you would love to volunteer, you or anyone on your team, please sign up today at nytech.org/nytech volunteer corps. You can always find that information on our website. And then our upcoming events, we have 2 more events before the end of the year. The next one is Wednesday, December the 2nd at noon. It's a founder spotlights in partnership with Grasshopper Bank, featuring Regina Nguyen, the founder of Tressa Noir, and she's also a co-founder of Black Women Talk Tech. It'll be a really great conversation. We hope that you can join us then. And then on Tuesday, December 8th at 5:30 will be our last New York Tech meetup for the year. We will be doing our women's demo night. Applications are open. You can find they close tomorrow at actually today. Today's Friday. Wow. They close today. So if you are a woman founder or know of any women founders who would like to demo, we recommend that you submit the application as soon as possible. You can find that and information about both events on our website at nytech.org. There's 3 ways that you can support the organization. The first is to make a small donation when you RSVP for any of our virtual events. You can also become an individual or corporate member of the New York Tech Alliance, or you can simply make a small donation at nytech.org. And then, again, we have a really phenomenal panel for you today. I'm going to go ahead and turn it over to Paul Ellis to take over from the panel. I will see you again at the end of the event. Paul, take it away.
All right. Andy, thanks very much. Again, my name is Paul Ellis. I'm a board member here at Tech Alliance. I also run some of the events related to legal, financing, this M&A event, and similar activities. So it's great to have a good group this afternoon. We have a great panel for today's discussion. We've got Ben Boissevain, Managing Partner of Ascento Capital, Patrick Sullivan, Founder and CEO of Bonsai, as well as a serial entrepreneur. And we've got Alan Wink, Director Capital Markets of Eisner Amper. So we really have a great group to take up this title. So we're going to start by quickly going around the screen, as it were, brief introductions. So again, my name is Paul Ellis. When I'm not doing Tech Alliance events, I'm the managing partner of the Paul Ellis Law Group. We're a 9-lawyer boutique firm in Midtown Manhattan. We do a lot of work with startup, small to mid-size tech and tech-enabled companies. Our clients are looking for us to give them cost-effective and efficient solution to their legal issues, so they can focus on growing their businesses. To that end, we do different types of financing, angel, venture capital, seed. We do M&A transactions, as we're going to be discussing today. We also do general operational matters such as employment agreements, equity plans, IP protection, and the like. Our lawyers all come out of top law schools, big New York firms, so that we're able to offer sophisticated expertise with the more personalized attention and the more cost-effective billing structure of a boutique firm. With that, I will turn it over to Ben.
Hey, thanks, Paul. I appreciate it. Ben Boissevane. I'm a managing partner with Ascento Capital. We're a boutique investment bank focused exclusively on the tech sector. And our main focus for practice area is M&A. Sell side accounts for like 80% of our practice. So representing companies on the sell side and occasional buy side, occasional capital raise. And my own background personally started as a lawyer as well, White and Case. Went to Europe, to Vienna, Austria at Erste Bank, and then came back, joined Barclays Bank, and did a few boutiques before Ascento Capital.
Thanks, Ben. Why don't we go with Alan?
Good afternoon, everyone. Hope everyone is safe and sound during these crazy times. My name's Alan Wink. I'm the Managing Director of Capital Markets for EisnerAmper. EisnerAmper is a global accounting and advisory firm with offices across the United States and 6 international offices. I get involved with our clients in the areas of capital formation and corporate finance, mergers, acquisitions, divestitures, strategic alliances, etc. I do a lot of work in the tech space. I was actually one of the co-founders of the firm's tech practice about 18 years ago. And glad to be here this afternoon.
Very good. Patrick?
Hi, I'm Patrick, founder and CEO of Bonsai, an online marketplace for career advice, and we focus mainly in music and tech industry right now. Thank you.
All right, very good. Again, really pleased to have you all with us. So let's talk about briefly what we're going to do today. The title of our event, M&A Exits During Uncertain Times, Evaluating the Alternatives and Preparing for a Transaction. So those of you who follow our Tech Alliance events may know that a couple of times over the years I've led a panel on long-term preparations for an acquisition. And we had planned to do that event this year, but in discussing with Andy during the pandemic, we realized that maybe we needed to change up the topic a little bit because we were both recognizing that for some founders, the question was really, when is the right time to exit? Is it now? Is it later? What are my options? How do I make the decision about where I want to go and what the next step is? So we sort of broadened the topic a little bit to bring in some other elements while still keeping in the sort of long-term planning piece. The one thing I would say is that for people who are interested in a deeper dive into sort of the long-term planning for an acquisition, the last time we did that full event was in 2018. It was an hour and a half. And so for people who are want that sort of full content, they can find it on Tech Alliance's YouTube channel or on the resources page of my firm website. But to get into today's event, we're going to be starting to talk about strategic planning and understanding the alternatives, developing the alternatives, so you have some choices about how to take your company forward. We're then going to go into an update on the capital markets, what things look like right now for what the exit market looks like, what the financing market looks like. That helps to inform your choices. We're going to talk about what the team is that's required for an exit, who you need to have on board. And then we're going to get into preparations, both legal and accounting, talking about what you need to be thinking about 12, 18, 24 months out from a transaction in order to be ready when the time comes. So again, our focus is on not the specific deal, not what do I do when I have a term sheet, but what should I be thinking about, 6, 12, 18, 24 months out in order to be ready when the time comes. I'd also say, it's a lot of content. We're going to try to get to a short period of time today. So it's not as though we'll be able to give you all the answers, but we really want to make you think about the process, think about the questions, so that you're a little bit more prepared as you head up towards an exit. And with respect to Q&A, we will try to do that a little bit as we go and a little bit at the end. There's a question field where you can enter in questions, and we'll be sort of picking them off as we go. I'm guessing we will not get to all of them. We'll certainly do what we can, and I think everyone on the panel is going to be able to stay for at least some time afterwards at the different tables, the virtual tables. So if you didn't get your question answered, you can go to, speak to someone at that point. So with that, we'll go to our first topic, which is strategic planning, and we'll turn that over to Ben.
Great, thanks, Paul. I appreciate it. Yeah, just as a basic background, it's a fascinating market right now in that there's a lot of capital out there. There's like $2 trillion in private equity as an example. And then the major deals are not happening. But the small add-on deals are happening. I'll get into that a bit in this conversation. So it's a good time if you're a relatively healthy, small, private company in the tech space to go out and hit the market. So the key is to develop alternatives and bring options to your board in this environment. Paths to consider, hold and grow. Certainly it's always an option. Hopefully, there's no major need, you're not running out of runway, and you can just explore the market in any case, and you can always not take an offer. That's the key. You don't have to take any offer. Equity and debt financing is possible as well. Depends on the stage of the company, but venture capital, private equity, corporate venture capital. I will mention two things here. One is that private equity is, once again, got $2 trillion of dry powder, and a lot of the portfolio companies private equity are acquiring. The other part, if you're looking for financing, there's venture capital, which, unless you know people, it's a tough gig right now, venture capital, that's my read. They are financing companies, but typically who they know already. A better port of entry is corporate venture capital, just because everybody has corporate venture capital. Google does, Google Ventures, as an example. Car companies do to finance innovative companies and get a look-see into the industry, into innovation. And then there's the sale of the company, which, you can look at strategic buyer, you can look at a large strategic buyer, you can look at merging with a similar sized company, you can license your product and, potentially spin off a division. So there's a lot of different options to look at. And what I would encourage companies to do is not just think about one path, but explore multiple paths. Go in parallel. Look at financing. Look at M&A at the same time. That way, you generate options for your board. Happy to get any comments from the panelists.
Just one comment, Ben. You talk about the venture capital space, and it's interesting how vibrant VC has been during the last 8 months during the time of the pandemic. And I think a lot of people felt that, deals would sort of stop in Q2 and maybe stop for the rest of the year. But, it's funny, in the third quarter, I know we're going to talk about this in the next slide, deal activity, both in terms of value and in terms of number of deals was way above the first and second quarters of the year. And it's really an interesting time in that you're seeing, a lot of venture capital money deployed. You're seeing a pretty frothy exit market. You're seeing a relatively hot IPO market, and then you put SPACs on top of that. It's really quite interesting how good the deal market has been.
I agree with that. Yeah, no, you're right, Alan. It's amazing. I mean, looking back in April, you would never expect it. But, once again, there's a lot of capital to deploy, right? There's a lot of activity. And the other aspect, at least in my sector in tech, there's a lot of new innovation. If you just look at the data analytics sector, it's going really in a fascinating direction, combining data analytics with artificial intelligence. So I think there's a lot of innovation going on. So that's going to spur financing and M&A.
And you think about the tech space, and you think about what COVID has created. And I think one of the best quotes I've heard during this process was from a native New Yorker, Andrew Yang, former presidential candidate, who said at the beginning of this pandemic, we've seen 10 years of changes in 10 weeks. And I think a lot of investors are trying to take advantage of those changes in terms of, great new companies that are being created by entrepreneurs all over the country.
Absolutely.
So Patrick, you're our entrepreneur on the panel to keep the rest of us honest. You have any thoughts on this you'd like to add?
Yeah, from an investment perspective, I've never had so much inbound in all the companies I've been involved in, from just angels to venture capital. We've actually decided as a company not to take institutional investing right now, so we're pushing it out to the new year. So it's been pretty interesting just to have the conversations, but inbound, and then push them away. We raised quite a bit of money as well in COVID, but we stuck to pretty much angels, and it was more strategic for us to do that. But I think in any market, whether it's up or down, it's all about what your business is and what pain you're solving for a particular company that you need to be in position for. And I've been fortunate to be through 2 exits that were pain solvers for both Google and Facebook. And so even the craziness of the market, and I agree with Alan, the innovation that's happening in this market is incredible. And we're seeing some fast moving tech companies coming out of the gateway. And so, but it's pretty exciting, for me, as being been around the block a few times.
Yeah, I'd also say that it's true that investment took a dive maybe in Q2, but where I sit, both in terms of M&A activity and activity, it's ended up to be a pretty robust year. From my tech clients in the New York market, there's been a lot of investment activity, there's M&A activity. So against all odds, the market seems to have held up, at least locally. What the year to come brings, we will see. Why don't we move on to the next slide?
Great. Yeah. So I think the key here is to really develop a key set of alternatives, and the first bullet point is really a realistic set. Depending on internal factors, stage of development, financial position, market opportunity, industry. So a good indicator here in this first bullet point is on the M&A front. If your competitor is selling, there's probably a reason for it, right? Because maybe it's a good time to sell. Maybe it's a really hot sector, an exciting sector, and the M&A is going to hit that sector. So you don't want to be the 8th guy in your sector to sell. You don't. You want to be the first or second guy to sell. Your valuation is going to be a lot higher. So that's key. I talked about the parallel path already, but it's really important to look at exit opportunities for M&A as well as financing in parallel. They kind of play off each other, actually. If you get term sheets from VCs and letters of intent from M&A strategic partners, you've got choices then, and your board can decide, which one's the better offer. Is it financing or is it an exit? That helps. Timing is essential. I've seen a lot of companies in this environment. If you're in restaurant software, as an example, or hospitality sector, where they're running out of runway and that they pull the trigger too late on an M&A process. It takes 4 to 6 months. You don't want to run out of capital in the middle of that process. I've been through a few of those. They're very exciting. Actually, I've gotten them done. But you want to allow at least 6 months for the sell side. As I already mentioned, the last bullet point, demand or a few VCs, strategic buyers. I'll just mention one other thing before we go to the next slide and leave it open for the panel. But, it's interesting for me. I'm doing an M&A sell side right now for a data analytics company, and we have 4 written offers on the table. We just selected the winning bidder. And in that process, we had 2 bids from M&A backed companies. From private equity backed companies. One was Warburg Pincus, pretty well-known private equity firm. The other one was Silver Lake. And they're backing these companies, their own portfolio companies, to make acquisitions. So that's one area to look at in terms of targets. It's not only the logical strategics, but also do your research, look at private equity. They're trying to deploy their $2 trillion of capital right now, and they're having a hard time doing it because they're not doing major platform moves. They're doing these little add-on deals. So if your deal is 20 to 100 million, private equity should definitely be on your target list.
Hey Ben, quick question: Are you how are strategics competing with private equity firms from a pricing standpoint?
It's a great question, Al. I think that strategics typically pay more in a market, but the private equity guys are raising the bar now. They're actually pretty competitive from a pricing perspective. They have not been in the past, to your point, but now they have to be in order to compete.
So Ben, one of the questions that came in was how have valuations been faring amidst the pandemic? Obviously, it depends on the industry sector to some extent, but what are your observations generally?
I think it's pretty consistent with 2019, surprisingly, except for if you're in a sector like travel or leisure, anything that's really hit by COVID, you're not going to be doing too well in valuation perspective. But if you're not in those sectors, you're doing fine, pretty consistent. And then if you're in a super hot sector like unified communications, a la Zoom, those valuations are through the roof.
Right.
Can be an impediment to M&A actually, because then the board thinks, hey, I'm worth 20 times revenue, right? And they don't get that in the market. They're disappointed.
Right. Hey, Patrick, any observations?
Yeah, I would say from the entrepreneur perspective and CEO, make sure you know who you're marrying, whether it's from a strategic investment or an M&A transaction. And, it's great having boards, but at the end of the day, I think you can control your board dynamics, even if you can get outvoted, where you could turn the deal down with the strategic or the investor if you don't feel it's a right fit. And I've gone through that where I had a board that was trying to influence the deal in a transaction. And, my advice was to the board members, which they didn't control the majority, was I'll shut the company down if you don't do the deal. And so, just remember that, it's you as a CEO and entrepreneur that have to make the final decisions, and try not to let these sometimes aggressive board members try to push a deal that you don't want to do or feel comfortable with. Be cognizant of the fact that you should be able to decide the outcome and the transaction, and do your homework around the venture capital world, because there's good and bad out there.
Yeah, the other option, Patrick, is not to do any deal, right? I mean, you don't have to do a deal. I think people forget that. Against my own interest as a banker, I get a fee on the success.
Yeah.
The reality is you don't have to do a deal, whether it's a financing or an M&A event. You can wait another year.
Yeah, and again, I've been on the board. I've been on boards with companies that I feel the CEOs were getting, beat down a bit by the board members. But at the end of the day, make sure you choose wisely and get to know the people that you're getting into bed with.
Oh, good. Why don't we move on to our capital market slides? We've already sort of touched on the big picture here, but let's dig into the numbers a bit.
Yeah, sure. So happy to start this off, this slide. Little impact on the VC market. I think that's actually right. There's a lot of investment activity, $37.8 billion and 2,990 deals, higher than Q1 and Q2. So that's great. It's $26.6 billion in later stage, Series C and later. VC exits, $103.9 billion, which is fascinating. I think in the VC market, it's also worth noting that the VCs themselves are raising capital, right? And people forget that, but the VCs are deploying capital, they're also raising capital, and they're going to LPs, limited partners, and raising a record amount of capital right now, because alternative assets are actually got a pretty high ROI compared to other investment opportunities if you're a pension fund. So it's good to keep in mind that when you go to VCs, they're also raising capital. And I'll turn it over to Alan for the SPAC bullet point.
Just a couple of comments on sort of the VC market. It's really interesting. A couple of years ago, over the last 24 months, a lot of private companies could continue to raise capital and didn't have to pursue the public markets, because a lot of the big VCs had raised large pools of capital and had to deploy it, and they still have to deploy it now. What's interesting is you're still seeing these mega deals, deals of $100 million or more, but you're also seeing this really frothy IPO market. I mean, last quarter there were 13 IPOs with valuations greater than $1 billion, which is really kind of crazy. So you're seeing the perfect storm. You're seeing a frothy, VC investment market. You're seeing a lot of big deals still getting private capital, and you're seeing a frothy IPO market. And on top of that, you're still seeing VCs raising large funds from LPs. It's like the perfect storm and should position us for a couple of really good years of VC activity.
So, Alan, let me raise a question that came in. So, what's the reason for that? Why are the markets so strong? And how long can we? I mean, no one can know for sure, but what's the expectation for the future to the extent that you're prepared to hazard a guess?
I mean, first of all, VCs are looking for these great returns, and they can find them by investing in these great technology companies around the globe. I think you're seeing technology come to even a higher point because of COVID. And, I think a lot of the changes that COVID have brought about, working from home, telemedicine, therapeutics, are not going away in the short term. They're going to be here for a long time. I think, we're going to change how we do business in the future. I think these changes are permanent. I like to hear, Ben and Patrick's comments about that, from an investor perspective.
I will say, my particular company, which is an online platform for one-to-one video chats, I would have never predicted that 100% of the world will be using video, and that has led to quite a bit of interest in the venture market for inbound. And I've seen such a pipeline of people, just curiosity, because people are doing this, what we're doing today, online now, and the relevancy in great companies similar to AirMeet, like Run the World is another product that was created by an ex-Facebooker who's raised a ton of capital. Lunchclub.ai, which is a similar to my company, just raised $40 million and $100 million valuation. So the space in particular that I'm in right now is super hot. The interest is super high from the venture capital markets. And, I could never have predicted this, as we were building the product out pre-COVID. So it's been pretty exciting. And I think in the tech space around online, platforms, it's been amazing.
Patrick, you should always say you're pressing. You predicted this 2 years ago when you started the company.
I wish a year ago, if you were in my house and I launched my first product, and we were by the Titanic, and I was in the dark days of an entrepreneur. No matter what, all the successes I've had, I was feeling like a failure, and we had to reimagine the product, and we started to think about online career advice and mentoring. Right now, this period of time, I launched a product November 18th last year. So,
wow,
this is a very monumental point in my life. But
it's a great story.
Yeah. A question came in. What about the geographic context? I mean, to what extent is the market similarly impacted across the country? Are there particular hotspots? What are your thoughts on that?
Just to comment on that, Paul, because I actually was on a webinar earlier this morning with a tech group in Florida. So, part of these numbers come from that presentation, but, it really is, California, the West Coast, East Coast still dominate, certainly Northern California, but even in Florida, literally almost 10% of the VC dollars that have been, invested this year have gone into the southeast part of the country, which were, until recently not thought of as tech hubs. And now they are, and you think about, prior, companies on the East, New York and San Francisco, that's where computer scientists wanted to be, and now, these people can work from anywhere. So it's going to be interesting to see what the geography of tech investing looks like in the next 5 years.
Yeah, I'll mention, Alan, that's a great point. I think that one trend I'm seeing is, disparate teams that are in, Silicon Valley, India, Ukraine, Park City, Utah to go skiing. It doesn't matter really where you are anymore. And, it used to be the case when M&A, for instance, like, where's your team? Are they all in the same office? That sort of mentality is going away. People are getting more comfortable with disparate teams working together on these platforms.
What about overseas? I mean, what about Israel? What about Europe? That's a question that just came in from the audience.
Israel's super hot as usual. It's just an amazing amount of innovation going on there. I mean, and I've sold 4 companies from Israel, and just put Israel on there, and they automatically know the tech is going to be world-class tech. In terms of Europe, I've just got a buy-side inbound. So they're actually pretty active in Europe, despite the law.
Good, good. Why don't we go on to the next slide?
Do you want me to take this, Paul?
Yep.
Okay. When we kind of looked at the capital markets, we kind of broke it into two segments. One's being venture capital and one being private equity. I think the private equity markets from a deal flow standpoint have been down for the first 9 months of this year. First 9 months of 2020, deal volume was down, 16.2%, and deal value was down 20.6% from the prior year. Q2, as Paul said prior, deal completion really hit rock bottom. It was the lowest deal value since 2015. But I think there's a great deal of optimism on the street right now because the number of announced deals is certainly increasing and certainly pointing to a strong finish for 2020 and a good start to 2021. And I can't downplay at all, what Ben said earlier. There is so much money tracking deals today, $2 trillion of dry powder. You'd expect that the market should be pretty vibrant for the next several years. Fundraising has slowed down a little bit this year, but I think that was expected because it followed 2 or 3 years of record fundraising amounts. So I think, it's been a healthy year for private equity in 2020, maybe not as vibrant as prior years, but I think the indications are it's on the uptick again for the next several years.
Oh, good. We want to keep on track on timing, but Ben, Patrick, any quick comments on that?
One comment that I have, a good friend of mine here runs a $3.6 billion private equity fund, and he says he's seen a lot of fire sales. Would that be a contributor, you think, to the equity deal worths of a lot of certain sectors got hit harder, and so he said he's in buy mode. He's got more deal flow than he imagined, but he's saying the price point for the valuation of the companies are pretty low.
No, absolutely. There's definitely some fire sales within the wrong sector, right? So if you're in travel, hospitality, software, there was just a deal that clicked off last week where private equity came in and swooped it up, and it's distressed M&A. I will say there's probably distressed M&A than previous cycles because a lot of people just fold and move on, right? So there's a little less distress than usual. The other comment I'll make is, once again, that the smaller mid-sized deals are very active right now. The large transformative deals, talk to IBM, they're not doing the huge deals. They're doing, the $100 million, $20 million tuck-ins, and same thing for private equity. They're not doing the large platform deals. They're doing the add-on to their portfolio company deals.
All right, let's move on. So now we're going to transition to another question, which is getting your company ready for the transaction. So, we've sort of assessed the alternatives. We know what the market looks like. We're looking at a time horizon towards an exit. What do you need to start doing to be ready when the time comes? The first topic we're going to talk about briefly is just the team. Having the team in place so that when you're ready to go, you have the people you need. Key players we've listed here: accountants, lawyers, financial advisors, and then we talk a little bit about the internal team. With respect to accountants and lawyers, I think a couple of observations to be made. One thing that I focus on, when I talk to people about this, to clients, potential clients, is getting the right expertise. You need industry. You need someone that knows the industry, but you also need someone that knows how to do deals. I often will speak with clients or potential clients that come to me, and they have a lawyer who knows their industry very well, maybe handles their day-to-day issues, contractual issues, licensing, whatever. But that's not the lawyer they need to get the deal done. They need someone who knows how to buy and sell companies. So that's important to think about, that when you're putting your team together, when it comes to your lawyer, to your accountant, make sure it's your people that know how to get deals done, that know how to buy and sell companies. On the accounting side, what becomes especially important is being able to do the tax structuring correctly, to get a tax efficient structure for the deal. That's often sort of a tag team between the accountants and a tax lawyer, but one way or another, you want to get that, you want to get the structuring right, because that can make a big difference. It's not so much the deal price, but how much money is in your pocket at the end of the day. And the tax structure makes a big difference. And that's something that you should be thinking about, certainly while you're negotiating the LOI. Tax structure is not something that you need to think about after the fact, but certainly not later than when you're talking about the LOI or the term sheet. The other thing I'd say is about size. Make sure when it comes to your accountants and your lawyers, you're working with someone that's sort of appropriate for the size of the deal. If you're doing a $5 million deal, that may be a different team than the $50 million or the $500 million deal. You want someone for whom your deal is going to matter. It's going to be an important deal. They're going to give it the right sort of attention, but they're not going to kill you with the deal fees. And with internal team, I'd say do not underestimate the amount of time that it takes to get an acquisition done, and how much is required of your internal team, your business people, your financial people. Do the diligence process, getting the documents in the data room, answering questions, follow up, clean up. It's a huge strain on your internal resources, and something that I've seen happen from time to time with my clients. They get so focused on getting the deal done that they lose their attention on running the business, and their numbers they stumble on their numbers. And if the deal gets delayed, then the buyer says, "Oh, your numbers are going down," and they want to negotiate the price down, or God forbid the deal tanks, and then they've got a bad quarter or two under their belt because they weren't focusing on the business. So having the internal team in place is really key as well. I turn that over to you guys. Any thoughts on those points?
I guess, Paul, the only thing I would say, relative to finding the right team for the right size transaction is really important, because, I think when, professionals will say to you, there's no such thing as a small deal, just a small fee. So I think you want to select a group of professionals that are certainly, competent, but also a deal of this size gets them excited, and they're accustomed to doing deals in that size range and in that space.
Absolutely. Patrick?
All of this is super critical, and I'd say to the entrepreneurs on the call, do this the day before you start your company. Get all these pieces together, do the diligence, get all your docs in order, and have a processes and have a data room prepared. I learned the hard way with my first company when we went through the M&A with Google. They had 52 people on the buy side who were looking at our company and poking at our company, and we made so many fumbles along the way of just having organization of our documents. And, even like a big mistake for startups is an LLC versus a corporation, the tax benefits. I'm sure Alan, or who's that from Eisner, can go through the benefits. And, if you start your company as an LLC because you think about, it's a benefit to me personally by having an LLC, the C Corp is so valuable, the tax benefits when you do that transaction. And I learned the hard way with my first company. And so think about, when you first start your company, you're the accountant, you're the lawyer, you're the financial advisors, but you need to think about how to get the right accountants in place, the right lawyers and the right advisors, and then that transcends and builds out the company. But, do it the day you start or day before you start your company. Get all this. When we were getting acquired by Facebook, we basically had our data room ready. We were like, here you go. And they were like, there was no challenge around it the second time around.
Wow.
Yeah, just to point that, I think that you're absolutely right. Get ready now. The other thing is to interview people, like get a few accountants, a few lawyers, a few bankers, at least two, so you do your fiduciary duty and figure out what kind of sector experience they have as an example. I think that One of the main value adds of a banker is if he knows your sector, he knows the buyers, right? He can go to the buyers and get you actually some airtime with the buyers, some exposure to the buyers, which you could not get on your own, which is very valuable. That can actually lead to it.
Yeah, I would say with respect to financial advisors, sometimes I'll have clients that are starting a process and they come to me, do I need an advisor? Do I need a banker? I would almost always advise yes. It may be a small bank, a boutique bank, whatever, but an advisor can help to structure the process, can help to identify potential buyers, can help in the negotiations. So yes, there's a fee involved, but usually it's money well spent in my experience.
Paul, I agree with everything you guys are saying. The one thing for the entrepreneur, do not mislead yourself in thinking that some independent company is going to sell your company. It's you. It's your company. It's getting in front of what's called the deal sponsor within the corporate transaction side. And it's not the corporate development people at Google or Facebook who sit around the table. They do that at certain levels when they buy a company like Waze, and Larry is sitting around and go, what's the market look like? Who should we be considering? But at the end of the day, it's you figuring out who is the person within the org. Is it product, which has been the case of two of my exits, that you're solving a pain for them? They'll do their build buy analysis, but make sure you're solving it for that particular product team or org that you're trying to sell into and buy into, and not be misled. A lot of entrepreneurs come to me, hey, who at Google should I talk to? I'm like, what do you mean, who at Google should I be talking to? You should have been talking to Google if they're one of your M&A tracks, and you need to know who within Google is you're going to solve a pain for. And don't be misled that some other company is going to come along and say, oh, we'll figure that out for you. That doesn't happen. That's unless it's magical.
No, that's exactly right.
That came in, I'm going to pose to Patrick. For the entrepreneurs who are heads down, focused on growth of their companies, and need to start due diligence and data room preparation, how do you advise them to start?
Well, when you start your company, you should know if you're in the mindset of one day wanting to get acquired. And I always say, know who your acquirers now. So when I started my second company and my first company, I had a list of who those companies were that I'd one day want to do a transaction with if the timing was right. But the more important thing back to that question is, just make sure everything is dotted, all the diligence, the docs. You file your 83B election. I don't know if you want to get into that. That's a big mistake. There's a tax benefit if you do that right. All these things need to just be organized and controlled. And as an entrepreneur, you forget you're out selling, you're out running, but you need to do this if you one day feel you'll be in that. Don't get overly distracted by it, but just keep a nice cadence and have someone in particular that who can operate that part. I was fortunate to have a great corporate internal lawyer who did it who did all the corrections in the first startup, and the second one he was along the journey again, and he organized everything in a critical way. But the more important thing is you have to do both. You have to sell and you have to operate your business.
All right, got it. I'm going to keep things moving here. Alan, you and I have 15 minutes for the last 4 slides, so let's go at it. And that was Patrick gave us a good segue in terms of preparations. So on the legal side, I'm going to go through this real fast. These are things you need to think about. As Patrick says, think about them early, get them done early. I say to my clients all the time, time is not your friend when it comes to these issues. If you get them done early, you can get them done relatively easily, relatively cheap. If you postpone them, it's going to be more difficult. It's going to be more expensive in terms of legal fees, and it could cause problems with your deal. So founder ownership and voting rights. This is something I often see sometimes when it's not the initial founders, but someone will come in, like employee number 1 or number 2. There'll be some sort of handshake deal, like a mini founder, but it doesn't get properly documented. It's not clear what the rights are, and it gets postponed. That can be a real problem when it comes to a transaction. There's nothing that a buyer is going to be more concerned about is if there's discord among the founders, the owners, or what their rights are. And you're potentially giving that person who has uncertain rights, control over the exit. It could be a holdup. They can hold out for a better deal than they would have had if it had been resolved up front. So get those issues addressed early, get them in writing, so long before you're considering an exit. A related item is shareholder rights. You should have a proper shareholders agreement or operating agreement in place that anticipates an exit. It should have proper drag-along provisions so a majority can pull the minority along with them, appropriate voting provisions so that nobody has a holdup right. Again, these are things, if they're addressed early on, when everyone's interests are aligned, it's relatively straightforward to get it done. As time moves on, interests can diverge, then it becomes more difficult to get them settled. Contracts and their provisions. This can be a big issue. Contracts, these are contracts with your counterparties, with your customers, with your vendors. We're talking about things like anti-assignment and change of control clauses. So an important contract will terminate if the company is sold. Right of first refusal, this can come up with a contract with a strategic partner. Long-term leases and contracts with take-or-pay provisions. That is to say, if you don't buy a specified amount, you have to pay a portion of the price of the services or goods you didn't buy. Unusual limitations on liability or warranty commitments, exclusivity provisions. All of these are types of provisions that if they get into your contracts, when it comes time to do a deal, when we're going through that diligence process that we've been talking about, that Patrick was talking about, the buyer is going to look at these contracts and go, oh my God, this is a key contract, but it terminates upon this deal. And then you may have to go back to that counterparty, try to renegotiate the contract. Maybe you can't do it. The price changes. The buyer gets cold feet. So all of these things, think about these contractual provisions at the time when you enter into the contract, what the implications can be if you're contemplating an exit. Andy, why don't you give us our next slide? So then some other issues, intellectual property. This is critical, and of all these things I've spoken about, this can be one of the biggest issues when it comes to getting a deal closed. Ownership is a big issue. You got to have proper agreements in place with the employees, with contractors, with the founders, especially a founder who's left the company. Any of these people who've left the company, if you don't have an agreement in place saying that the company owns the IP that they created, that could be a problem, because that's one of the first things that a buyer and their attorneys are going to look at to make sure there's proper chain of title, that the IP that they're buying is, you can demonstrate that it's owned by the company. Failure to register IP rights that need to be registered, patents, trademark, copyrights, failure to police them. If someone's infringing your valuable IP rights and you haven't gone out there and said, knock it off, a cease and desist letter, that over time, that weakens your IP rights. It can weaken your IP rights. So you need to have an IP lawyer that's keeping track of that stuff. Open source software issues. You got to have policies about open source and make sure that it's not getting into your company's code, at least not without knowing what's happening. Trade secret protection. To the extent that your company is relying upon trade secret protection for your proprietary rights, you got to have NDAs in place. You have to have a trade secret policy. You have to enforce it. Otherwise, those rights may be compromised. And finally, in your agreements with your counterparties, your licensing agreements, for example, make sure, don't just pull the standard agreement off the shelf and push it out. It's important to have, for an IP lawyer, to look over these agreements. If the agreement's coming from the other side, don't just say, this looks like the boilerplate. This is your IP. This is the lifeblood of your company. You need to know what rights you're giving away and make sure that you're not creating problems for yourself. Personnel issues. As I note here, employees are rarely unimportant in a transaction. Know whether your employees are being properly characterized as employees. If you're using independent contractors, make sure they truly are independent contractors. That'll be liability on the company that the buyer will look for you as the owner to indemnify them for. Retention issues. You want to make sure, if employees are important in the deal, you want to make sure they're going along. The vesting provisions, double trigger acceleration should be set up all the way along from the first day of the life of the company to make sure that employees are incentivized to stay there through the exit. Consider retention bonuses as a way to keep people around, especially during those challenging days up to the point of sale. Guys, any thoughts on those points? Patrick?
I agree with everything. So I mean, I'm just thinking back all the things I've had. The employee one is so critical. Getting all that in order. You definitely with your consultants or get everything papered. It's so critical and important, and you have the right advisors around the table. But I've seen definitely with other people that I've been advised or been asked to advise, the weakness in IP ownership or their deal structures and, the term limits on it. And, these are all things that are going to be uncovered and unpacked, and you may not be as valuable to that buyer. And you got to be very careful, how you transition through that period.
Absolutely.
The only thing I'll add, Paul, you may cover this a little later, but, the shareholder structure is really important to make sure that you understand who has an option right, who has shareholder. I'll give you an example. I had one deal where the CEO owned 100% of the company, which is rare, and he had promised his CFO X percent. It wasn't clear what that percentage was. And the CFO was actually rather critical to the operation, so they had to negotiate that at the last second. You don't want to leave that for the last second. You don't want to have any uncertainty.
Yeah, I'm working with a company right now that is a similar situation, and they're really concerned. Well, they have not yet gotten to an exit, but they don't want to give someone a hold-up right. That at the last minute, that person can extract a better deal than they might otherwise have gotten. So, Alan, any thoughts?
No, I'm fine. I'm fine, Paul.
All right. So, Alan, we'll turn it over to you.
Okay, I know I have only a couple of minutes, so let's try to go through this.
Alan, we can actually go over a few minutes, so
Okay.
Okay.
Thanks, Paul. And I think Patrick touched on a couple of these, but we'll talk about long-term preparations from a transaction from an accounting and tax standpoint. And I'll be the first one to admit that these might not be the most exciting topics, but I will say if you don't do these correctly, you're definitely going to prevent the deal from happening, and you're going to wind up in a lot of discussions during due diligence that might delay or even not allow a deal to happen. And I think Patrick alluded to it earlier in his comments. I think what you try to do is, from an entrepreneur's perspective, is, being diligence ready from day one. Running your company as if, you're going to be going through a sale transaction or a capital formation transaction at any point in time, because you never know when a potential buyer or investor is going to knock on your door and they've heard about your company, they have some interest, and they want to talk. And I guarantee if you're diligence ready, the valuation of your company will be on the higher end as a result of it. So, make sure your online data room is complete and up to date continuously. You want to have, accountant prepared financial statements, preferably audited by a recognized CPA firm. That's really, really important because you want to have numbers that a potential investor or acquirer can depend on and feels comfortable with and confident in. You want to have financial models and projections prepared that are, reasonable and realistic, and you have assumptions that back them up, because everyone's going to want to take a look at what you expect financial performance to look like in the future. You want to make sure that you're following, GAAP revenue recognition policies. It just makes it a lot easier when you go through, financial analysis by a buyer or an investor at some point in the future. We spoke before about, the cap table. You want to make sure it's complete and all stock options and warrants have been appropriately accounted for. Quality of earnings reports. I mean, we're seeing a lot of our clients that are expecting to go through a transaction at some point in the future do sell side due diligence. And so they want to make sure that all these issues are taken care of before a buyer or an investor knocks on the door. And you also want to make sure that all related party transactions are appropriately disclosed. Next slide, please. Next slide, please. Thank you. The other side of the equation is, the tax issues relative to your company. So just make sure that all your federal, state, and local tax filings are current and up to date. Making sure all tax carry forwards are disclosed for the benefits of potential buyers. The issue of nexus for state income and sales taxes is always an issue. Make sure you know the states that you have nexus in. Cybersecurity and data privacy issues, becoming more and more important. Buyers are certainly looking at past issues of data breaches that your company has gone through. So be prepared to talk about those. EBITDA adjustments, make sure they're documented and appropriately explained. And then sort of a new topic, and I'll tell you an interesting story about this, is the issue of PPP loans that a lot of our clients, a lot of our companies have received as a result of the CARES Act and COVID-19 and the forgiveness issues relating to those. And I know, Paul, you probably have seen a number of transactions where there have been existing PPP loans on the books and how you're going to handle those in a transaction, whether there's going to be escrows set up for that. I got a call late last night from one of my partners on a situation that I had never seen before relative to a PPP loan. Was, one of our clients was selling their business, and both the buyer and seller were going to pay off the PPP loan prior to the transaction being consummated, which they did. So concurrent with the signing with the closing of the deal, the loan was paid off to the bank. So they weren't even going to be applying for forgiveness. They were paying it off early. Well, I guess the bank neglected to notify the SBA that the loan was paid off. And they had very early on, our client had applied for forgiveness. The bank was going to, forget about the forgiveness applications, accept the prepayment. And unfortunately, the bank never notified the SBA. So we paid the bank off for the loan. The SBA also paid the bank because they had given them full forgiveness. And now there's an extra $1 million hanging about that we have to figure out what to do with. So make sure your PPP loan forgiveness is appropriately handled. And hopefully that'll end sometime in 2021. But that's all I have from an accounting and tax perspective.
Yeah, I would agree with that, Alan. PPP forgiveness has all of a sudden become a big issue, and part of what makes it an issue is, the SBA and the banks are still figuring it out. And people are to some extent making it up as they go along. So that's a challenge. It's deal with it early. The one overriding point I'd make about these last couple of topics. To go back to what Patrick was saying about get it done early, the nature of the diligence process when you're in a sale transaction is that the business people, the lawyers, the accountants, they're going to start flipping through your data room, and there's almost a dynamic that if everything is in order, corporate docs are in order, accounting, contracts, but they'll start to say, okay, everything looks good, this looks good, check, check, check. If they start to see problems, then they start to wonder, well, how is this company being well run or not? And they may start to dig a little bit deeper. And the deeper they dig, the more issues they find, and it can become sort of a downward spiral. So you want the process to be smooth and effortless. You want the data room set up so they're just sort of getting into this mode of checking the boxes. Because as everyone on this call will tell you, once you get your leverage only is going to decrease after the LOI is signed. The purchase price, generally speaking, only goes one way, and it's down. So you want things to be smooth, you want them to be fast, frictionless. That's how you get the deal done as fast as possible, and you get the highest purchase price possible.
And Paul, I absolutely agree with you. And that's why I kind of said in my opening comment about if you're diligence ready and you give the impression to a buyer that you're a well-run company, you're probably going to get a higher valuation. So don't downplay the fact of trying to be diligence ready. It really, really is important.
Yeah, and as Patrick noted, he said like do it day one. That's great if you can, but for goodness sakes, if you think that you have an exit coming, 6, 12, 18 months, today, yeah, you need to start thinking about that. Talking to your accountant, talking to your lawyer, internal, outside, whoever it is, to make sure you're getting that process ready of looking through your documents, getting stuff into your data room, so you're ready to go. Ben, you have any other thoughts on that?
Yeah, just one other point. You want to make sure you give them no excuses to either crater the deal or lower the price, right? And clean due diligence is really critical. The other aspect is to make sure that your projections are on track, right? Your revenue, EBITDA projections are on track. One classic board member question, you don't know much about the transaction, are they on track? And if they're like 10% below their projections, you've got a problem. They're probably going to lower your valuation. So you should be conservative the next 6 months on your financial projections, because you want to make sure when you enter the M&A process, at the end of that process, the board is confident that you're going to beat your projections. 5 years from now, you can be $1 billion. For the next 6 months, you want to be conservative.
Guys, I'd like to get one or two more questions out there. Although markets are performing well, funds going to women and underestimated founders is low in comparison. Funding for women in Q3 lowest since 2017. What are your thoughts on how to fight against that trend, and for women and underrepresented founders, how they deal with those facts?
Paul, go ahead, Ben. I'm sorry.
No, go ahead, Alan. That's fine.
I was going to say, Paul, it's absolutely an important issue. And I think a lot of venture capital firms are addressing it. And, they certainly understand that, women and underrepresented minorities are not getting, the amount of venture capital dollars that they would like to see. And, it's almost a numbers game where, I think if they get more introductions to women and underrepresented minorities in terms of seeing deal flow, that the numbers would certainly increase. But I do think it's an issue that a lot of VCs are looking at.
Yeah, I think they're looking at them. A question of what they're actually acting. We'll see about a year from now, right? Because the reality is that most VCs are white male, right? Just the reality of the industry. It's unfortunate, but so I think there is a diversity component. The other thing I would say is, corporate venture capital is probably paying more attention to that issue. I was just on with City Ventures yesterday. They're actually looking at that issue because it's critical for Citibank.
I'd also say, there are a number of funds out there now that are having a particular focus on underrepresented founders, which is a good trend. I agree with you, Ben. People are talking the talk. We need to see over time whether they're going to walk the walk. Another point I would make, for in our last webinar, which was an update on venture capital, that was one of the focuses of the topic. So people who want more information on that particular question can go and look at that video. It's, again, available on the Tech Alliance YouTube channel. It's available on the resources page of my firm's website, or if you write to me, I can send you that link. Um, Final thoughts, Alan, Ben? Yeah, Alan and Ben?
No, Paul, I just want to, first of all, thank you for inviting me to sit on the panel this afternoon. I thought it was a great topic and a great discussion. And, I look forward to the end of 2020 and the beginning of 2021, because I think it's going to be a really great year for transactions. And I think it's going to be a great year for venture capital investment. And I think we're going to continue to see a frothy market through at least 2021.
Yeah, I'll just echo what Alan said. I think 2021 is going to be a gangbuster year. There's a lot of pent-up demand, a lot of new tech coming online, and should be really interesting.
All good. So in closing, thanks to the panel, to Ben, to Alan, to Patrick. Unfortunately, we seem to have lost Patrick. There's going to be networking, so please stay after. If we didn't get I think we got to all the questions that came up, but the three of us will be hanging around afterwards. You can come to the tables designated by our firms in the virtual environment. If you're interested in the video, the past video on long-term preparations, again, you can find that on the my firm website, along with some videos we've done on venture capital and angel financing over the last few months. And thank you all to the participants for tuning in this afternoon. With that, Andy, I will turn it over to you.
Awesome. Thank you so much again to this amazing panel and to everyone who attended. We are recording it, so we'll be sending out the video links through our newsletters and through our communications in the next week or so. And to that last point, the last question that was asked, we're working on some programming to help guide founders to access some of those different streams of capital that exist within the tech ecosystem, as well as specifically for diverse founders. So please stay tuned to upcoming program in 2021. Again, thank you to all the panelists. Terrific conversation today, really valuable information. You can always find the recordings for these events on our YouTube channel. We hope to see you at the next event. So thank you so much. Happy Friday and enjoy the rest of your day.
Okay. Take care.
Take care, everybody.